but the paper company is wholly owned by the family holding. So if paper company sells paper to the newspaper company at twice the market rate, okay? In total, if you consolidate it, nothing happens. I mean, that guy makes, let's say paper should be, it costs 100. You sell the newspaper company at 200. So paper producing company makes $100 and newspaper company pays $100 more than it should. So it loses money, right? If you consolidate it, nothing changes. But if you're not consolidating, paper company makes $100 in profits, all of that goes to the family. Newspaper company loses $100 on top of everything else, but only 51% of that loss, indirectly at least, is family's loss. In fact, it's not even 51, because they own 51% of the main holding company. Then that company, main holding, owns 51 of the media holding. Media holding owns 51% of the newspaper. So they're actually responsible for only about 1/8 of the loss. What did you do? You essentially transferred $88 of profit to the family at the expense of public shareholders. Koreans had a beautiful name for that. They called it tunneling. You basically create a tunnel from the paper company to the family holding company, and that tunnel goes through all public companies and transfers the profit. That's why we have consolidated earnings, because with tricks like that, you could misinform shareholders. Remember, the purpose of financial statements is to inform any stakeholder, not just shareholders, about how the company is doing. You know, if you could do something like tunneling, then those financial statements don't mean anything. And oddly enough, countries that allow practices like those on a comparable basis, typically their stocks trade at a 20 to 30% discount compared to countries with better accounting standards. Why? Because I don't know how they're going to do it, but I know they're going to screw me, okay? So when I'm buying that company's shares, I wouldn't pay $100 even though the business model says it should be $100. I'm going to say I'm going to do $7. So in a sense, they're screwing themselves, but they don't realize it. But in US, we don't have that problem. But when you combine or consolidate across different countries, the way you do it, you translate financial statements using the exchange rate at the time. So I have a Japanese subsidiary in case of Amazon. You know, they made 100 billion yen. I'm going to convert that 100 billion yen into US dollars. Let's assume that the rate is 125 right now. I think it's around 140, but let's assume 125. That's equivalent to about $800 million. Okay? But from year to year, you have, even though nothing changed in the firm in local currency terms, you made or lost money because of the currency adjustments. None of that would actually be listed in income statements or balance sheets, or they are listed in the balance sheets. Your assets are, let's say the currency of that country depreciated. The assets look a lot less than they should be. This is kind of a contra item. You're making an adjustment for that. But you would see things like that in what you want to call other comprehensive income. And unless you're an accounting major or a finance major, you don't want to get into that. It's not complicated, but you need to spend time on exactly what they mean, especially if you're valuing the firm, you gotta pay attention to those things. All right. These guys, they call it the balance sheet. Now, as we talked about it, just to wrap up, balance sheets are organized in the order of decreasing liquidity. By liquidity, we mean the speed with which you could convert an asset into cash without losing too much value. I can convert anything into cash quickly if I'm willing to get a haircut. Give me a Boeing 747, I can sell it within 5 seconds on eBay if I list it at $10 million instead of $500 million or whatever the value is. Obviously, cash is the king. Sometimes we have things called cash equivalents. Some firms list them separately as short-term investments. These are things that can be converted to cash very quickly, like treasury bonds or small number of shares in stocks. You can sell 100 shares of Google very quickly, but if you have 1 million shares of Google, it may not be that easy to sell. Okay? Those wouldn't be so-called short-term securities. They're typically marketable securities. Even there, you need to make a distinction. Then inventories. Most firms would list accounts receivable before inventories, but in the case of Amazon, they may be actually more liquid because they have a very efficient inventory management system. After all, their inventory does not comprise of cars. Then you have fixed assets, and liabilities are listed from in increase order of increase, how long you have to wait before you pay them. So short-term liabilities are listed first, then longer-term liabilities. Now, on the income statement, just like we have in balance sheet, these tell a story, okay? So if you're gonna tell a story with the income statement, we're gonna start with so-called net sales. How much revenue, how much stuff you sold. Now, when we say sales, for accounting purposes, that's kind of a very precise concept, or revenue. Something is not, there's a principle called recognition principle. It basically says a sale is recognized as revenue when the sales process is essentially complete and there is reasonable certainty that you're going to be able to collect. It's not when you actually collect it. You can sell something on 90-day credit, it's still a sale. And sales process is going to be complete as soon as you ship it. I don't know if you guys ever noticed when you order something from Amazon, your card is not actually charged until it ships. Because once it ships, it is no longer company's, it's yours. Of course, every once in a while, either something's going to happen to shipment or it's going to be returned back. That's why this thing talks about total net sales. Sales minus any rebates or returns. Then we have something called cost of sales, all right? Cost of sales is also known as cost of goods sold. Sometimes it's also called cost of revenue. This is how much money you had to spend to produce these sales, other than things that are fixed in nature. For example, we have a corporate headquarters, any rent we pay for that building has nothing to do with how much I'm selling. that is not part of cost of goods sold. Or you pay salary to CEO. You know, whether CEO makes $5 million or $10 million, you sold, he's gonna make that money, whether you sold 10 million items or 20 million items. So those are not part of cost of goods sold. But a warehouse worker, you pay that guy, that cost goes towards the production of that revenue. So that's part of cost of goods sold. I don't know what that fulfillment is. Again, there is no standard for these.
I think fulfillment is like through like centers where they take returns and stuff.
Oh, okay. Technology and content. These are probably things they pay on things like Prime Video. Sales and marketing costs. Promotions, advertisement, what have you. Technically speaking, these are not cost of sales, should be here. The rest are called operating expenses. Again, let me open a different company. We'll get better interpretations. For example, let's say Ford Motor Company. Come on. I'm gonna post both of these anyway. See, these guys call it income statement. Amazon called it statement of operations.